This is what I call the digital Suez Canal. Solana is the digital Strait of Hormuz. It's the digital Panama Canal of the 21st century. So it's not just about speed, it's just not about efficiency, it's not just about scale, it's about also tearing down the historic barriers and letting every citizen, entrepreneur, and global citizen be able to participate equally in our capital markets. Now the infrastructure is really finally ready to be able to warehouse the $500 trillion global securities market. That SOL will generate north of $100 million of free cash every single year, just simply by virtue of being staked. Forward Industries is going to be executing a ton of Solana buys in the future.
Michael, GM, and welcome to Solana Floor.
GM, Finn, appreciate being on and love your account. I think it's phenomenal. I would appreciate if you'd retweet me a little bit more. Let's get those retweets up. And for your listeners, great to be here. Happy to get going.
Awesome. Well, yeah, Michael, thanks again so much for being here. Galaxy Digital has been a huge backer of Solana since as long as I can remember. Do you want to just, first of all, outline your Solana bull thesis for me and make it clear why you think that Solana is the most performant L1 and why it's got the greatest future ahead of it?
For sure. Let's start by facing the reality we live in today. And I think this is really important for your users to understand how I think about it. Global finance today is a fortress guarded by layers of intermediaries, banks, clearinghouses, and entrenched financial institutions that hold monopolies over the flow of global capital. These are the powerful, self-interested gatekeepers that keep most of the world's citizens on the outside looking in. They dictate who gets access to capital, they set the fees, they set the rates, they slow everything down with layers of regulation, and while all extracting rent. The system today is slow, it's expensive, and it's fundamentally unequal because it was built to benefit the people that control that system today. And that is a bad system that we need to disrupt, and it is ripe for disruption. In August, SEC Chair Atkins threw down the gauntlet with Project Crypto, declaring that the entire financial machinery of global capitalism must move on-chain. And from our perspective, from my perspective as head of DeFi at Galaxy, there is only one blockchain today poised to make that vision a reality, and that is Solana. So from our perspective, by the end of this decade, the reason why Solana will dominate global capital markets and why it will have a majority of tokenized securities trading, not on the NASDAQ, not on the New York Stock Exchange, not on the London Stock Exchange, but on Solana, is because Solana will operate a superior global infrastructure, a supercomputer, a global supercomputer operating on 20 millisecond block times via multiple concurrent leaders, capable of processing 1 million transactions per second. It will be running on dark fiber through 00, using multicasting to propagate updates instantly and permissionlessly at the speed of light. That power means that Solana can absorb not just certain markets here and there, but the entire $500 trillion global capital market volume. And when it does this, it will unify all of these fragmented markets today. We've got markets in New York, we've got markets in Tokyo, we've got markets in London, we've got markets all discreetly all over the place, reading different ledgers. By putting them on Solana, we will have one global unified ledger. This is what I call the digital Suez Canal. Solana is the digital Strait of Hormuz. It's the digital Panama Canal of the 21st century. Just as controlling those routes once defined global empires, I think embracing Solana now will shape which nations lead in the digital age. And lastly, Finn, the real triumph to all of this is Solana is not going to be like traditional historic empires. It's open to all. It dismantles the fortress, of the old intermediaries and democratizes finance. So it's not just about speed, it's just not about efficiency, it's not just about scale, it's about also tearing down the historic barriers and letting every citizen, entrepreneur, and global citizen be able to participate equally in our capital markets.
That's a beautiful point because it really kind of brings us back to that first principle of democratization and saying that, everyone should have access to financial inclusion. Everyone should be able to access free markets via the internet. So it's very, very fundamentally bound by the crypto ethos. I love the analogy of the Suez Canal. I think that's a really, really eloquent point. And it's a really critical inflection point, actually, because, imagine Chair Atkins comes out and he says, let's do Project Crypto, but let's go back 4 years in the past. Imagine it was Gary Gensler who came out with that when Ethereum, the L1, was the biggest blockchain. And we actually wouldn't be well equipped to execute on Project Crypto in that circumstance, would we?
No, we wouldn't. I actually think a significant percentage of securities today would trade on-chain already, if not for the regulatory, horrifically destructive regulation by enforcement that we had over the last 4 years, right? If it wasn't for the regulators doing everything in their power, largely at the behest of the banks, to kill crypto, or at least siphon crypto off, strangle it in its crib, I think the technology has been largely ready to be more efficient in a lot of different ways. And so I think a lot of global commerce would already have been trading on chain. That said, the infrastructure over the last 4 years was in build mode. And I think now the infrastructure is really finally ready to be able to warehouse the $500 trillion global securities market.
And so just before we dive into all the DAT stuff, are you able to give me a bit of an overview of your role at Galaxy Digital and how that factors into Ford Industries operations moving forward?
So I'm the head of DeFi at Galaxy Digital. Galaxy Digital is a publicly traded company on the NASDAQ. I believe that Galaxy is arguably the largest publicly traded company in the world that participates in DeFi today. Participates in DeFi on a trading level, participates in DeFi on a liquidity provisioning level. And in my role as head of DeFi, what we focus on is building the next generation of cutting edge, high frequency trading infrastructure for decentralized markets.
Excellent. So Michael Saylor obviously pioneered and popularized the model, the DAT model. And while it's evidently worked out really well for him, there's an argument that Bitcoin treasuries are fundamentally hamstrung by their inability to generate cash flow. They don't have native staking. There's no way to kind of sweat those assets and really make the most of them there. So Ethereum offers this to some degree, but Ford Industries sees Solana as a much better opportunity. Why is SOL the best asset for a DAT strategy today?
So in order to answer that question, let's just talk about the core premise of MicroStrategy's model. MicroStrategy converts asset volatility, namely Bitcoin asset volatility, into amplified equity gains. And it does that by tapping the convertible bond market and the preferred equity markets. But it's really important to understand what that means. In order to tap the convertible bond market, you need to have a volatile stock. And in fact, MSTR is volatile. MSTR has a 1.77 beta to Bitcoin. That means when Bitcoin goes up 100%, MSTR goes up 177%. When Bitcoin goes down 100%, MSTR goes down 77%. So it's much more volatile than Bitcoin. And it weaponizes that volatility to access superior terms for global finance and global borrows. However, there's a potential flaw, and I don't want to FUD MicroStrategy. I think it's a fucking brilliant company, and I think it's doing incredible things. But there is a flaw in a Bitcoin DAT model. And the flaw is that in order to repay your convertible debt that you borrow, you need to issue new convertible debt.
Yeah.
You have no free cash flows from Bitcoin. And what if that market dries up? I hope it doesn't. It probably won't. But it could. And if that market dries up, then all of a sudden you're in a position in which you have to issue new converts or issue new equity or issue this new preferred equity that MSTR issues at worse rates. Now enter the Solana DAT. Recall what I just said about how MSTR weaponizes the volatility of the underlying asset Bitcoin, which is quite volatile, obviously. Solana is about 51% more volatile than Bitcoin. And so if MSTR holding Bitcoin creates superior volatility that gives it superior access to capital markets for cheap, good borrows, stands to reason that a Solana DAT with a more volatile underlying asset could get even better terms in the convertible debt markets, because Solana being more volatile than Bitcoin increases convert holders' likelihood that they will hit a premium and be able to convert their debt into equity. So that's one big thesis and one big issue for the Bitcoin DAT model that we think the Solana DAT model solves. Now, there's another thing, which is arguably more critical, which is Solana generates free cash flow. So when you are a Solana DAT and you buy Solana and then you stake it, you get 7 to 8% in inflation rewards every year. Now, a lot of people talk about inflation and they say, oh, that's not real, it's nominal yield. If you're a Solana DAT, you're getting real money in the door, right? I mean, imagine for a second if I just dropped a bunch of SOL on the table right now, Finn, and I said, do you want that SOL?
Obviously,
And
yes.
I said, obviously, yes, but you wouldn't care if I got that SOL because I got inflation rewards from staking it, or if I just bought it on the open market, or if just someone else gave it to me, right? It's the same thing with Bitcoin, right? Bitcoin miners generate Bitcoin by mining Bitcoin. No one ever says to Bitcoin miners that, well, the Bitcoin that they mine isn't really that valuable because it's the nominal yield of Bitcoin, right? They're mining Bitcoin that they can sell in the open market. And so Solana generates free cash flows. So the DAT that Galaxy sponsored, Ford Industries, we raised in one of the largest pipes in history, $1.65 billion, that we immediately then turned around and bought Solana. So Ford bought Solana. And that $1.65 billion of SOL that Ford was able to purchase is staked right now. That SOL will generate north of $100 million of free cash flow every single year, just simply by virtue of being staked. Now, why is this an improvement on the existing DAT model? Because if you've got free cash flows, you don't have to enter the capital markets to pay back existing convertible notes should you issue them. Now, to be clear, no Solana DATs, and as far as I believe, no Ethereum DATs have issued convertible notes yet. But that's obviously the game plan, right? Like you get to a certain size, and then you start not just issuing equity, but you start issuing convertible notes. Well, at least that's the MicroStrategy playbook, and it's a very good playbook. But presumably, eventually, BMNR and ETH DATs, as well as Ford Industries and Solana DATs, will get big enough where they can tap the convertible debt markets, but they can issue convertible notes at on an even better terms because they have this pool of capital, this free cash flow that they can use to pay off the notes when they come due. Does that make sense?
It does make sense, yeah. And I kind of want to touch on the yield aspect of this, because all DATs are arguing that maximizing SOL per share and maximizing accumulation through staking revenue is the ultimate goal. And various DATs are approaching this in different ways. So some of your contemporaries are saying that they're optimizing hardware so that they can back the best transactions in the last 50 milliseconds of the block. What's Ford Industries' edge here if everyone's kind of going for exactly the same model of trying to maximize that SOL per share?
I don't think anyone's actually going after the same model. I think the model that Ford Industries will go after and is going after is unique to Ford Industries because it's been sponsored by the three most elite Solana companies in the market. Galaxy Digital, most elite asset manager in the market by far. Jump, the builders of Firedancer, and the most elite high-frequency trading company in the world, especially in crypto. And Multicoin, the strategic visionaries that seeded and led every single Solana round. Those three parties are the real edge that Ford Industries has in outsmarting the market and innovating and gaining edge. And so you can think about it like this. When you stake $1.65 billion worth of SOL, you get $1.65 billion of something called stake weight. Stake weight is a superpower on Solana, and it doesn't exist on any other blockchain. Ethereum doesn't benefit if you have a lot of ETH nodes. You don't gain some ETH weight. On Solana, you have stake weight, and what that gives you is two incredible superpowers. First, the more stake weight you have, the faster prices you get on chain. And that is because the higher in the turbine tree you are to get state updates. Second, the better execution you have because you have something called stake weighted QoS, which is to say, the more stake weight you have, the more priority, privileged, trusted access you have when sending transactions to other validators. And you have a bigger tunnel through which to push transactions. Now, let me ask you, Finn, what do these two properties add up to? Faster prices, better execution. Well, they add up to superior access to Solana's DeFi markets. If you know how to use those two properties correctly. There's no one in the market right now, or frankly, no one in the market in the future that is going to be better at accessing and leveraging stake weight than Jump and Galaxy working together to optimize its Firedancer nodes and to leverage that stake weight to provide liquidity directly to the market and participate in DeFi. So the edge that Galaxy and Jump can bring to Ford is an edge on how to use the infrastructure to maximize SOL per share in a way that no other DAT knows how to do and can do.
Okay, that's really interesting. I'm gonna bring that back to a point we made in the beginning. So, I'm just playing devil's advocate here. In the beginning, we mentioned that the promise of Solana is, democratization, open financial inclusion. Anyone can come onto the chain and trade anything. And through stake-weighted quality of service, you're saying that the likes of Jump and Galaxy and Ford Industries are going to have a discernible edge over everybody else. So is that kind of a betrayal of that vision if people who have a lot of SOL have an inherent edge over everybody else?
No, I don't think it's a betrayal of vision, because the alternative is that, so having a lot of SOL on Solana is a proxy for trust. If you have a lot of SOL, then other validators can trust that you have a lot to lose should you misbehave.
Right.
What happened before, Solana did not always have stake-weighted QoS. It created stake-weighted QoS because Solana had a much worse problem previously. The problem that it had that was worse previously was that there was no stake-weighted QoS and there was massive, almost a cancerous spam that took place, which slowed down the entire network, crashed the network. And your users will actually find this very important. The reason why Solana had spam and the reason why stake-weighted QoS was so important is because Solana does not have mempools. And therefore, every time a validator is the leader on Solana, it is effectively getting DOSed with transactions. Now, how does it determine which transactions to include in a block and which it should not include? How does it know? It's pretty hard to know without stake-weighted QoS. With stake-weighted QoS, it is probably the worst option of all other options, which are much, much worse, which is to say, it at least looks at who it's sending, who is the sender or the router of the transaction. And if they have a lot of SOL, they can trust that that entity is legitimate and is probably not spamming. Now, this is not to say that Ford, by leveraging its stake-weighted QoS, is doing anything wrong. It's actually the opposite. Ford has $1.65 billion of stake. And so it's going to leverage that stake to provide superior liquidity on chain, to provide superior access to capital on chain, and to help grow in a responsible way the Solana ecosystem.
Perfect. Thanks. So I'm going to switch the conversation over to the kind of DAT and ETF trade-off there. How do you see DATs and ETFs coexisting as the TradFi meets crypto investment vehicle for traditional investors? If I'm an institutional investor or an ultra high net worth individual, why would I consider investing in a DAT over an ETF?
So let me just say, first and foremost, it's massively bullish that SOL ETFs are hitting the street soon. Massively bullish. It's going to provide a product to Wall Street and to retail that they understand and they can use and they can trust. And it's going to provide hedge funds and ARB funds the ability to arbitrage between SOL DATs and the ETFs, which they've effectively been doing with the ETH DATs and the ETH ETFs, which has resulted, in my judgment, in more volume for ETH DATs than for SOL DATs thus far. So that's point one. Point two, they will soon realize that SOL DATs are superior in every single way to an ETF. And the reason is because, one, a SOL DAT can stake 100% of its SOL if it wants to. An ETF can't. An ETF has to have free SOL available for redemptions. Point one. Point two, a SOL DAT can access global capital markets to secure superior leverage than any other vehicle on Earth, including ETFs. So let's compare a SOL DAT for a second to a levered ETF. A levered ETF has not historically beaten an unlevered ETF. And that is because levered ETFs reset their leverage every single day. And so when you look at the performance of levered ETFs, say 2x levered ETFs, what you find is they have volatility decay, which is to say they actually perform worse than if you had just held the underlying instead of holding it with 2x leverage because of the nature of resetting your leverage every day. And so If you want juiced up exposure to Solana, a 2x levered ETF is not the strategy. The strategy is buying shares in a Solana DAT that can access superior leverage that does not reset every 24 hours, namely hitting global capital markets for 5 to 7 year fixed term bonds at zero coupon. I just want to really underline this point, Finn, because your viewers need to hear this. The reason why SOL DATs trade at or should trade at a premium to NAV is because these vehicles have superior access to leverage than any other comparable vehicle. Take a hedge fund, for example. A hedge fund cannot just issue bonds to the capital markets and receive cheap borrows. Can't do that. And it certainly can't do that on fixed terms, 5-year terms, 7-year terms. It can only borrow, a hedge fund can only borrow on margin, which is to say they borrow against the value of the assets they hold. And as we saw last Friday, that is extremely dangerous, especially if you are a long-term holder of these assets. If you've got a 5-year thesis that Solana is going to go up in price, what you need is a vehicle that can weather short-term volatility, but give you levered access to the underlying. That's what a SOL DAT does, and that's why it should trade at a premium to NAV.
I want to come back to what you mentioned earlier about prop MEMs and meta aggregators and all that like. So when Ford Industries did its big market bid and it purchased $1.65 billion worth of SOL, $1 million of that was routed through DFlow. Why was DFlow chosen for that purchase? Why not a different aggregator like Titan, like you mentioned earlier?
DFlow and Titan are both phenomenal. I mean, they're incredible products. Both of those teams are innovating. I'm very close with the Titan team. I think they're one of the best teams out there. Why did Ford choose to buy through DFlow? Kyle made the decision, and frankly, it's a good decision, right? I mean, DFlow was able to execute very efficiently 1 million. However, this is sort of what I'm alluding to. If I were advising Ford Industries, I would be advising them to start executing every big buy of SOL going forward, a significant quantity of that buy directly on chain. You'll get better fills, you'll get better rates, you'll get tighter spreads, and you'll be leveraging these really incredible primitives. So like Titan, like DFlow, like Jupiter, like these DEX aggregators that are just so much more advanced than any other DEX aggregators on any other blockchain, you're going to be able to get the best fills across multiple different market makers, multiple different prop AMMs and DEXs. And not only that, but there's a world in which Ford Industries, and if I were advising them, Ford Industries should be executing not just through DFlow, Jupiter, and especially Titan, but also through Axiom, through Banana Gun, through Trojan, through Photon, right? Those products have incredible reach. And not only that, those products have great limit orders. They can execute TWAPs over them, right? You're starting to see this entire ecosystem working for users. And Ford Industries is going to be executing a ton of Solana buys in the future if everything goes according to plan. And so by using at the top layer, Telegram bots, terminals, wallet infrastructure, that is really good. And then hitting DEX aggregators and meta aggregators who are then pulling liquidity across DEXs and prop AMMs. That overall system, in my mind, is as competitive right now to Binance. And therefore, I would encourage Ford to start accessing those rails to start buying SOL.
Okay, excellent. For all the bullishness on DATs, and obviously you're a big purveyor of DATs, there are some people who have some question marks around the model. There's a widely held belief that DAT proliferation could pose some systemic risk and structural risk. In the weeks leading up to the Ford Industries raise, a Galaxy Digital researcher, Will Owens, actually published a report saying that the capital formation flywheel was structurally fragile. Is there any truth to these concerns? Should people be worried about a potential DAT unwind?
No, my judgment, no, and I'll tell you why. What Will was referencing there was Bitcoin DATs, right, who tap leverage. And for the reasons I described earlier in this podcast, if you are a Bitcoin DAT, you are not generating free cash flow. And so in order to pay back anything you borrow, you need to issue new convertible bonds or new preferred equity, and the convert markets or the pref market needs to buy that equity, give you new cash that you then use to pay off your existing bonds. That is fragile because you don't know when you can do this. You don't know what the market's going to look like at the time you do it. And so in that world, it's kind of hard to believe right now, but of course we should talk about it because it's possible. In that world, if MSTR, their converts come due and they need to raise additional capital to pay them off, and the convert markets say, no, we're good, then you could start seeing some fragility there. However, let's not over-exaggerate the percentage of debt that MSTR has. MSTR has, I think about 10% of its total Bitcoin holdings was from convertible notes. It's got like a $80-90 billion, something in that range of Bitcoin. So it has enough capital and size to have quite easy access to raising. And while Bitcoin is ripping like this, they're probably issuing new preferred equity, and they're probably either buying Bitcoin or saving that capital in a responsible way to pay off future obligations when they come due. But those obligations are not so significant that there could be some sort of real calamity, in my judgment. Now, that said, converts are not obviously ideal for a Bitcoin debt for the reasons I just said. You have to tap convert markets in order to pay back converts. That's why MicroStrategy invented the preferred equity stretch model and strike and all of these different, they have 4 preferred equity instruments that are really clever and very interesting and are not debt instruments. They are equity instruments that rank senior to common, but junior to convertible notes, to debt. And those pref instruments carry various sort of dividend yields. Now, some of them, they don't have to issue dividends. They issue them if and when they feel like it. Others of them are cumulative dividends, which is to say that if they miss a dividend, the next dividend they issue, they also have to pay the previous dividend. And they have floating rates, dividend rates. Right? Some of them have fixed, some of them have floating. These are very interesting instruments. And they're all providing a blueprint for SOL DATs to take that model and once again innovate on top of it. Because, again, in order for MicroStrategy to pay any dividends on pref, it needs to raise additional capital by issuing convertible debt markets or pref markets to get new capital to pay this out. So that's why it's fragile, but Solana doesn't.
Right.
A SOL DAT has, so let's just take for very easy numbers. Let's say Ford Industries gets to be $10 billion, which is to say around the size that BMNR is right now. That would generate, just on the inflation rewards, ignoring the MEV rewards and block rewards and everything else, just on inflation rewards, that would generate $700 to $800 million a year. That immediately puts Ford Industries as one of the most profitable companies on the NASDAQ, full stop, because it has so few expenses, right? Now, with that $700, $800 million a year that it generates from staking rewards, it can do a bunch of things with it. The first thing it can do is it could issue preferred equity that is tied to the staking yield. It will get better terms for that preferred equity because it's tied to a real revenue stream. So it doesn't have to offer 8%. Maybe it can offer 6.5% or 5%, right? So there's a superpower here for SOL DATs because of the 7-8% yield that it generates. Now, if you can generate above 7 or 8% yield, which I believe Ford Industries plans to do through superior access to DeFi and superior access to running validator nodes and building blocks, you could actually have more competitive rates for preferred equity. So you see how this all starts to tie together. But to answer your initial question directly, and I want to be very clear about this, when someone asks whether or not these DATs could have a systemic cascade, a systemic impact, and crash the market, the answer I always ask is, or the response I give is how. Because right now, All ETH DATs, as far as I know, and all SOL DATs have no leverage. So there is no forcing function for them to sell a single GUI or a single Lamport. The only way that a DAT currently could start forced selling of SOL or of ETH is if a activist fund literally did a hostile takeover of a publicly traded company and forced the sale. But in that world, I'm a lawyer. I used to do activism work in a previous lifetime, so I know a lot about this. It is extremely difficult these days for activist funds to take over companies. It's not like the 80s anymore. We're not working with Gordon Gekko over here. There are a lot of rules now about how activist funds can acquire more and more equity into a publicly traded company, and it is very difficult to consummate a hostile takeover. I don't even remember the last hostile takeover that we had, frankly. So that is like a very sort of edge case. But if there's no leverage on a DAT, then there is no forced selling. Full stop. Now, if that DAT has a cash flow generating machine in the form of a Solana validator or an Ethereum validator, that makes it even less likely that they would ever have to sell a single GUI or a single Lamport because they've already got free cash flow coming in. This doesn't apply, of course, when a DAT takes on leverage. When a DAT takes on leverage, then they have to pay back those notes. But again, they have 5-year terms. And what you often see with convertible notes and repaying convertible notes is if the issuer is distressed for whatever reason, you can negotiate, and revise those indentures, which is the core documents that underlie the note. And so there's a lot of options for publicly traded companies and tapping publicly traded debt markets.
Yeah. And so let's imagine a world where Solana goes to $100 tomorrow and all Solana DATs are suddenly operating at a discount to NAV. How do you raise more capital to kind of continue the accumulation? Do you just have to wait for SOL to get back over that threshold again? What's the long-term survival case in there?
It's a great question. If Solana crashes, these DATs will trade at a discount to NAV, we don't really actually have to speculate here. Let's just look at MSTR, right? Like I remember when FTX crashed, it wasn't that long ago, and Bitcoin crashes to what, $16, 16,000? And the first thing I did was I checked MSTR stock. I was like, oh my God, MicroStrategy is going to get liquidated. This is what I'm thinking. But that's because I didn't know anything about MicroStrategy. I didn't take the time to read anything about how they actually financed their Bitcoin purchases. And when I read that and I said, oh, wait, they issued 5-year fixed term notes at 0% coupon. Wait, you're telling me that unlike me or unlike you or unlike everyone else out there that just got margin called, MSTR is not even at risk of ever getting margin called because their borrows are not secured by their Bitcoin. They're secured by their stock, effectively. Okay, wow, that's actually really killer. That's an insane superpower. And so, yeah, if Solana crashes in the future, it's going to look pretty similar to when Bitcoin crashed and MSTR was trading at a discount to NAV. And if you had bought MSTR at that time, when it was trading at a discount to NAV, and when the stock price dropped, you'd be in a pretty good position right now because it's been trading at a premium to Bitcoin.
Yeah, it's a great answer. Michael, we are approaching time, but I would just like to get one final hot take from you. What is, in your opinion, the most exciting thing coming to Solana DeFi in the next 6 months?
That is a very good question. I have a really good answer, but I can't say yet. Why don't you have me on next month or a month after, and I'll let you know.
All right, I'll be keen. I'll definitely be keen.
But some very exciting. All right, let me give the politically correct answer. Alpenglow is going to be phenomenal, right? Brennan Watt and Alessandro and the entire Anza team are just cooking over there. And so Alpenglow is going to completely revamp consensus and completely revamp a proof of history. And in so doing, reduce global settlement times to like 100 to 150 milliseconds, which is like insane, right? And so that's very exciting. I think there's going to be I'll give you a little hint here. Okay, there's a couple little hints. Solana's going to start really competing on decentralized perp markets. And I think Solana's core infrastructure is going to be a dominant force for perp exchanges. And I also think that there's going to be some core changes to how blocks are being built and how efficient and fast and how effective packing blocks will be in the future. So I'll talk more about those two things in another month when you have me on.
Awesome, Michael. I love how eloquently you danced around all those flag words. Michael, thank you again. A real pleasure having you on.
Thanks, Finn. Appreciate it.